Let's take a look at the operating cycle for a large supermarket that is obviously selling directly to consumers and buying its products off a range of smaller suppliers. So receivables days, 2 days. It's almost instant, and this is essentially because people are either paying in cash or there's a short delay while the funds clear on their card payments. So the supermarket gets cash in very quickly from its customers. If we look then at inventory days, this inventory balance is around 1.3 million. Cost of sales is just under £100,000 per day, so about 14 days is the amount of time that its products are sitting on its shelves. And that's an average. Obviously some will be much quicker, there's perishable goods, others will take longer. So it's about 14 days that its products are staying on its shelves or in its warehouses, 2 days of receivables days, so that's 16 days. But then you notice that there's a huge payables balance because payables days are around 90 days. And that seems very high, and often supermarkets almost exploit their smaller suppliers. Because of the size of the supermarket, it can negotiate very long payment terms. And what that means is that the supermarket essentially has a large payables liability, but this cash conversion cycle is actually negative. It's not having to pay its suppliers until around 74 days after it's actually being paid by its customers. So as a result, it's very good for cash flow, and here the cash is just sitting in the business's bank account. In reality, it would invest it in the business into fixed assets, which we'll learn about in the next course, or do other things with it. So it's a very good model for cash conversion because it receives money very quickly from customers, from consumers, and it can take a long time before paying its suppliers. On the other hand, its profitability is generally quite low. Profit margins are low, competition is high. So the trade-off for being a good cash converting business is that it's a low profitable one.